NIO stock closed today at $5.98, down about 1.64% for the session. And while that number on its own might not seem dramatic, the real story is what it represents. NIO has now dropped more than 12% over the past week. It has fallen below the $6 psychological level, and this decline comes just days before the company is set to report its third quarter earnings on November 25th. So the big question for investors right now is this: are we watching the early stages of a deeper breakdown, or is this simply a sentiment flush before a major catalyst? Tonight, we're going to slow down, take a clear look at what's driving this move, and figure out what it actually means. Let's start with the thing everyone noticed today. NIO broke below $6. That might sound like just another number, but in markets, numbers have meaning. $6 has been a psychological floor for NIO going back months, and even years, serving as an important support zone that traders watch closely. When a stock breaks below a major level like that, it can trigger automated selling. Stop-loss orders fire. Algorithms detect weakness and add pressure. Short-term traders panic and pull out. And suddenly a small decline can turn into a bigger move simply because the support line gave way. So the move under $6 today wasn't just about news or fundamentals. It was also technical. But while technical pressure explains part of today's drop, it isn't the whole story. NIO's weakness has been building for a while. This isn't a one-day event. It's part of a broader trend that's been dragging the stock down for weeks. When you step back and look at what's been happening, you start to see a combination of forces all pushing in the same direction. Not one big negative headline, but a cluster of smaller, persistent pressures that weigh on investor sentiment. One of the biggest issues in the background is dilution. That doesn't get as much attention day to day, but it absolutely shapes how investors feel about the stock. In September, NIO completed a $1 billion equity offering, adding roughly 182 million new shares to its outstanding count. That represents about 8% dilution. And dilution is one of those things that can sit quietly in the background, slowly eroding confidence. When you increase the number of shares in circulation, every existing share becomes worth a little less unless the company grows its earnings fast enough to keep up. So for investors who were already worried about NIO's losses, the dilution added another layer of concern. Speaking of losses, that's another factor weighing on the stock. Even though NIO hit record deliveries in the third quarter of 2025, and even though revenue is growing at a strong pace, the company is still reporting significant net losses. That's normal for a company investing heavily in growth, expanding internationally, and building out expensive infrastructure like battery swapping stations. But markets right now are not as forgiving as they were 2 or 3 years ago. Investors want to see progress toward profitability. They want to see margins improving. And when a stock continues to post losses quarter after quarter, you start to see hesitation, especially among institutional investors. Then there's competition. The Chinese electric vehicle market is the most competitive EV battleground in the world. Tesla is slashing prices. BYD is expanding aggressively. XPeng and Li Auto are pushing out new models and new technologies. Huawei-backed EVs are gaining traction. And dozens of smaller automakers are participating in a brutal price war. That means NIO has to fight harder for every sale, and the margins it earns on those sales get squeezed. It doesn't matter how impressive the delivery numbers look if profitability is being crushed by discounting and supply chain pressure. You also have the legacy of NIO's last earnings report. In the second quarter, the company missed analyst expectations on earnings per share. Revenue was strong, but profitability lagged behind what analysts were hoping for. And even though the company's guidance for the fourth quarter was ambitious, suggesting the possibility of breaking even on an adjusted basis, investors remain cautious. Lofty guidance is only as good as the company's ability to execute. And until they see proof, they will stay on the cautious side. All of that sets the foundation for what we're seeing today. But the story doesn't end with dilution, losses, and competition. There are also macro forces at play that have nothing to do with NIO itself. Chinese ADRs, meaning US-listed Chinese companies, have been under heavy pressure recently. Concerns about China's economic slowdown, regulatory uncertainty, and geopolitical tension have created a cloud over the entire sector. Today was another one of those days where Chinese stocks sold off across the board. Alibaba was down. XPeng was down. Li Auto was down. JD.com was down. When the entire group is red, NIO is almost always red too. Another factor happening behind the scenes is ETF outflows. Funds that track electric vehicle stocks, like the CARS ETF or the DRIV ETF, have seen investors pull money out this month. When those funds lose assets, they have to rebalance by selling the stocks they hold. And NIO is one of them. This creates a slow, mechanical selling pressure that doesn't show up in news headlines, but it absolutely affects the stock's day-to-day performance. And then there's the simplest explanation of all: earnings are coming up. When a company like NIO, which is unprofitable and volatile, heads into earnings, traders don't want to take unnecessary risks. So they sell ahead of the report. The closer we get to November 25th, the more you see short-term traders exiting, which pushes the stock lower. This isn't bearish or bullish, it's just investor psychology playing out. So the question that really matters tonight is whether this move under $6 is a sign of deeper trouble, or whether it's simply a sentiment flush before earnings. The most honest answer is that it could be a bit of both. On one hand, the break below 6 is technically important, and it's a sign that traders are nervous. Stocks don't fall for 8 or 9 days straight unless there's real caution in the air. And until NIO shows evidence of margin improvement and reduced losses, investor hesitation is understandable. On the other hand, nothing actually changed today in terms of NIO's fundamentals. The concerns people have now are the same concerns they had a week ago, or a month ago, or even 6 months ago. There was no new guidance cut. No operational setback. No regulatory issue. No lawsuit update. Today's move doesn't represent a sudden collapse in the business. It represents market fatigue, technical breakdown, and risk-off sentiment. If NIO delivers strong results on November 25th, particularly on margins and efficiency, today's $5.98 close could very easily end up looking like a temporary low, not the beginning of a collapse. If the company shows that losses are narrowing and that it's moving closer to that fourth quarter break-even target, sentiment could shift quickly. But if earnings disappoint again, or if margins contract further, then the bears will feel validated, and the stock could continue to slide. For tonight's video, the best message to deliver is that this is a moment of uncertainty, not a moment of panic. NIO is in a critical period. It's being tested by market sentiment, competition, and its own financial targets. But this week's drop is not a verdict, it's a setup. A setup for earnings. A setup for clarity. And maybe, a setup for a rebound if the company delivers. If you found this breakdown helpful, be sure to like the video, subscribe for more NIO coverage, and let me know in the comments. Do you see this drop under $6 as a buying opportunity or a warning sign? I'll see you in the next video.